Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, Yield Nerds, we are getting ready to talk about preferred stocks. And this is a very interesting topic for me because it really combines growth and income investing. And I hope you feel the same way about it as you learn more. Very quick and my usual disclaimers. This is not investment advice. I am not a wealth management advisor. I do not represent anybody. There is no secret agenda. I enjoy learning about income investing and I am sharing my knowledge. I welcome your feedback. All right, what we'll be covering in this episode is a good introduction about what preferred stocks are, the kinds of preferred stocks, the risks and the rewards, and then we'll go back to the almighty yield curve. And that is generally the framework we're going to keep referring back so you can understand how do you create passive income and how can you create something that suits your risk and your reward framework. And then there is an interesting conversation. There are books written in this subject about the arbitrage on convertible preferred stocks. So we'll spend a good amount of time on that. We'll always come back to tax implications, and then we'll buy some preferred stock and have fun with it. So let's get into preferred stock. You may remember from an earlier episode that there are three sources of capital for a company. One is working capital, so they buy something for $1, sell it for $1.25. The 25 cents is used to pay salaries, utilities, and so on, and there's a little bit of extra left, and that is what would be used to put back into the business to grow. The second is equity capital. They can issue new stock. They can go back and buy stock and take equity off the table. Or the third one would be debt. And preferred stock is really a combination of debt and equity capital. So it's somewhere in the middle. And so it's not a bond, it's not a stock, it's something in the middle. And that's what we'll be getting a little more into in this episode, the first part, and then a whole lot more into a deep dive as we move along. One more thing before we get into preferred stocks. I noticed that some of you are skipping the exact order in which the content is delivered. The reason I say that is because Yield Nerd is organized into playlists. And there is a playlist called the Yield and Income Roadmap. And the Income Investing Roadmap in numerical order lists each and every episode and part. And the reason I know you are skipping is because I can see that the view counts on a latter part are there when the view counts on an earlier part may still be 0 or a lower number. That tells me that you're viewing a later part before you view the earlier part. I can tell you right now, if you were in a class and you tried to take Algebra 2 before you took Algebra 1, you're going to have problems. You may understand some of it, but it really would not fill in the blanks. So my suggestion to you when you start looking at later parts is you go back to the playlist and make sure that you listen to the earlier parts. And when we start building on things such as yield curves and additional layering and things like that, you really need the prior foundation. Speaking of building on an earlier part, we're going to do that right now, except we're going to build on something we covered a long time ago, the lobster farm, the tomato farm, and preferred stocks. So let's get right there. Thank you. What do you know? We're back to the lobster farm. You may remember the story of the small little lobster, and you, as a growth investor, want it to become bigger and bigger, and you invest and you take an ownership position. Maybe you invest enough to have a quarter of the share of the lobster. But it's a quarter of the share of the lobster no matter how big it gets. That's why you're a growth investor. Well, there is a small problem. The farm owner needs more money, and they know that you don't want to give up your share of the quarter of the lobster income that you're going to get later on when the lobster is sold. So the farm owner says, let me see what I can do. Oh, wait, the lobster lays eggs. It actually lays a lot of eggs. And the number of eggs is not constant and it varies. So the lobster farmer says, what if I created a tomato farm program kind of thing inside of the Lobster farm? I'm going to sell the rights to the first dibs on eggs for anybody who wants to participate on that program. So the existing lobster investors say, hey, as long as I get a quarter of the price of the lobster when it's sold, I'm good. The lobster egg investors say, as long as I get 1,000 eggs a quarter or whatever it may be, that's what I'm in it for, I'm good. That is the preferred stock. The preferred stock gives priority in dividend income. It says when there are eggs, and sometimes there may be, sometimes there may not be. When there are eggs, you get priority in the first 1,000 eggs. When there are more than 1,000 eggs, then we're going to give it to the growth investors. And so the growth investor is happy and the tomato farm investor is happy. Now in a convertible preferred stock, you get to trade some of your eggs and baby lobsters from the eggs for a share of the giant lobster. Listen to Yield Nerd, and we're going to talk about preferred stocks soon. Thank you. All right, Yield Nerds. Hopefully that was informative and gave you a framework for how to think about preferred stocks. And if you thought life is perfect and you should buy preferred stocks for every dollar of your income portfolio, I just want to remind you that there are times that things go awry. You may remember the discussion from an earlier episode that not all tiny lobsters go on to become a giant lobster. Not all eggs hatch. Not all lobsters have eggs. So there is uncertainty along the way. And if your giant lobster project meets a different dinner table instead of yours, and turns out it does have some eggs that it left behind, you as the preferred stock owner have first dibs on the first 1,000 eggs in that example. So the question then is, can you go there and grab those 1,000 eggs and nobody's going to say anything? In other words, if the company whose preferred stock you own is in financial distress, perhaps in bankruptcy, what are your rights as a preferred stockholder? Let's look at that. Remember, the idea is that you have first dibs on dividends. You come ahead of others on dividends. That doesn't mean that it is the same case if the company is in distress. There are other classes of finance who are ahead of you. But when it comes to dividends or lobster eggs, yes, you are first in line. You get to claim your preferred dividends before common dividends are given. However, if the company is in financial distress or bankruptcy, bondholders are going to get their money back first before preferred stockholders. Just remember that you're not as good as the bond and you're better than common shares. Okay. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.